How to read and analyze company financial statements like a pro. Financial statements are the key to understanding the health of any company. It's a document that provides information about the company's position at one point in time. It shows the state of affairs of the business. Reading financial statements is not hard if you know what to look for. Financial statements are organized in a specific order which you can follow to get the general idea about a company's status. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now and subscribe to our channel to be notified when new videos are released. What is a company financial statement and how does it work? The company's financial statements are the most important documents that are used by investors to get knowledge about company's current state. The statement contains detailed information about the company's business and its financial health. There are three main sections of a company's financial statement. 1. The balance sheet. 2. The income statement. And 3. The cash flow statement. The balance sheet. The company's balance sheet is a snapshot of the business's assets and liabilities at a given time. It also includes a list of all the company's equity shares called shareholders' equity, which reflects the value that shareholders have invested in the company, as well as any additional funds they may have put in during the year. A balance sheet is usually presented with a list of assets and liabilities on one side and a list of owners' equity on the other. It is often considered as an important measurement of the financial condition of a business. The balance sheet lists all the company's assets, including cash, investments, buildings, etc. Then lists all its liabilities or debts. Finally, it shows what remains for the owner's equity. The three most important parts are: assets, what has been acquired during the period; liabilities, what funds have been borrowed; shareholders' equity, shareholders' investment in a company. The income statement. One of the most important sections of a financial statement is its income statement. It records all revenues generated by the company and its expenses for a certain period of time, usually 1 year. A net income is calculated by subtracting expenses from revenues. This figure is then divided by total assets to produce an amount known as return on assets, or ROA. The income statement shows what happened to those funds during that fiscal year, where revenue came from, how much was spent on various expenses, etc. The income statement also discloses what dividends shareholders received from the company, as well as any changes in share prices during that time period. The income statement is made up of three main parts: revenues, cost of goods sold, operating expenses. Revenues are the total value of all transactions that are completed. The cost of goods sold are the direct costs incurred in production. Operating expenses are all other costs that are not directly related to the creation or sale of products or services. The cash flow statement. The cash flow statement is the final statement in the financial statement. It measures the changes in cash for a given period of time, usually 1 year. Cash flow statements are usually divided into three sections: operating activities, investing activities, and financing activities. Operating activities measures the net change in cash resulting from all cash receipts and payments related to operations. This includes revenue minus expenses, plus or minus any changes in account balances that occurred during an accounting period. Investing activities measures the net change in cash resulting from all transactions involving investments. This includes checking with savings accounts, short-term investments, including purchases or sales of securities, long-term investments, including purchases or sales of securities, and any other investment activity. Financing activities measures the sale or issue of shares to investors and loans from investors. The company's financing activities are one of the most important factors in determining its performance. From time to time, the company may need to borrow money to meet certain obligations that arise from operating and investing activities. This could be for an investment, such as purchasing assets or paying for major construction projects. The financing activities also include obtaining funds from external sources, such as issuing debt securities and obtaining credit from other entities. Here's a comprehensive guide to financial analysis in companies. Financial analysis helps companies to know the extent of the company's financial growth. The main goal of this video is to show viewers how to use financial analysis for company growth. Financial analysis is an important tool that can be used by all stakeholders in a company. There are 5 steps in this process. 1. Financial statements. Financial statements are documents that provide information on the financial status of a company. They can be used as a tool for investors, so they can make more informed decisions and evaluate their own portfolio, and they can be used by managers to assess the performance of the organization. 2. Ratios and trends analysis. A company is only as good as its people. This is especially true when it comes to the supply of qualified workforce in the world today. Employers are constantly facing the issue of how to attract and retain talent. One solution would be to focus on company culture and allow for flexible work hours, telecommuting, free food, and other perks. 3. Capital structure analysis. A company's capital structure is an important factor in determining its risk, growth potential, and valuation. A company's capital structure determines the divisions of ownership in the company, example, common stock versus preferred stock, and how much control each type of owner has over the company. 4. Risk analysis. The company's management has a duty to disclose risks that may affect the company's value. Understanding the risks associated with a company can provide investors with clarity about their potential return on investment. This paper will identify and analyze the risks associated with a given company by identifying the type of risk, how it may affect the company's value, and how management can mitigate these risks. 5. Investment rate of return. The investment rate of return is used to measure the time rate of return for an investment. It is calculated by dividing the cumulative net cash inflow by the initial cash outlay. The IRR can be considered as a benchmark that compares alternatives to investments with varying risks and rates of return. The importance of financial analysis in company operations. When it comes to the importance of financial analysis in company operations, the following points are worth noting. Financial analysis enhances decision-making abilities. It helps to identify risk factors. It provides necessary information for effective governance and decision-making. Basic principles of financial analysis. Financial analysis is the process of evaluating a company's financial performance. This includes considering different aspects of financial health, such as net profit margins, debt ratios, and capitalization. Financial analysts use this information to make recommendations for investors and make decisions regarding the financing of new projects. This process requires complex computations, which can be simplified by using financial analysis software like Excel. One benefit of using these software programs is that they allow users to perform complex computations without having to know how, example, calculating the weighted average cost of capital. Furthermore, these programs can analyze vast quantities of data at once, which allows for more efficient decision-making. What is the right ratio we should be monitoring for effective financial analysis? The right ratio to monitor is the debt-to-equity ratio, which measures the extent to which a company is using its assets as collateral to raise funds. A low debt-to-equity ratio means that the company has few loans and has more equity, which makes it less likely that creditors can take assets from the company in a bankruptcy. This ratio also indicates that the company's net worth is much higher than its liabilities. The total liability-to-asset ratio includes all of a company's liabilities, including short-term and long-term debt, accounts payable, mortgages, capital leases, and any other liabilities. It typically ranges from 0% to 250%. How to analyze a financial statement in 5 steps. The following steps are designed to help you better understand the financial position of a company. Step 1. Determine the company's income statement by examining its revenues, expenses, and net income. The company's income statement is a financial statement that reflects the revenues and expenses of a business. It is a form of the balance sheet that includes the changes in a company's accounts over a specific period of time. Step 2. Examine the balance sheet to see what assets are owned by the company. A balance sheet helps investors see the financial health of the company by including all of its assets, liabilities, and capital. Step 3. Analyze other sources of information like management discussion and analysis, MD&A, or annual report to find out more about the company's performance over time. An annual report can be a company's most important annual report. It provides investors with the information they need to make sound decisions about the company's performance and future prospects. But what is an annual report? Where can you find one? How should you read it? Step 4. Calculate the return on assets by dividing net income by total assets. The return on assets, also called the ROA, is a measurement of the efficiency of company's use of all its assets. This ratio can be calculated by dividing net income by total assets. Step 5. Compare ROE with that of industry peers for insights into how well management has performed over time. One of the first indicators of a company's performance is its return on equity, ROE. This tells you how much you can earn for each dollar invested. ROE is calculated as earnings divided by shareholders' equity. In order to compare ROE with that of industry peers, we need to take into account the different sizes and ages of companies. Summary and conclusion. One of the most important aspects of reading a financial statement is to look at the balance sheet and the income statement. It is important that you take into account all of these elements when analyzing a financial statement. You should look at revenue, operating expenses, depreciation, interest expense, taxes paid, depreciation, and other expenses to get a better understanding of how healthy the company really is. In conclusion, a financial statement is an important document that is used to report on the condition of a company. It shows how much money is flowing into and out of the business. You can use financial statements to get valuable insight into what you are investing in and what the best decisions for the business might be. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.